Meanwhile, it is 1 year of GST. We've been getting you the best voices from India Inc. and the markets. This one voice combines both those perspectives. Rashesh Shah, chairman of FICCI and of course of Edelweiss as well, in conversation with Siddharth Zarabi. Let's cut across to that.
GST overall has been very positive, though there have been a lot of reports about some issues here and there. I think we should reiterate again and again that GST has been hugely beneficial to the economy overall, for sure. I think the collections have been very robust. It has increased transparency. It has also reduced a lot of inefficiency, a lot of arbitrariness in that. And I do believe that as things get more streamlined, as the technology stabilizes, we should see collections going up, and that will allow you to bring rates down also, because on an average, GST has brought the indirect tax rates down rather than take them up on an average.
Okay, I want to ask you another point. You know, there was a time for the Indian economy in the last 2-3 years after demonetization and the introduction of the GST, where there were fears about, lack of stability. In the present context, our markets seem to be reacting to various external stimuli, and you've seen what is happening to the rupee, Mr. Shah, 69 rupees, and the worries that continue around the NPA front. I just want a comment from you on the current state of the economy before we move on to discuss some more finer aspects of the GST.
See, if you look at the rupee, in the last 4 years, it has gone from 65 rupees to 69 rupees. Now, all of us seen in our careers, in our lifetime, rupee has always fallen. And one of the reasons rupee has always fallen is because our inflation rate is much higher than the global inflation rate. So as long as we have inflation, we should be accepting of the fact that rupee will fall. In fact, I don't think it has fallen a lot. A little bit of depreciation of the currency is also good, especially if you have inflation in your country, because that maintains your cost competitiveness in the global arena. So I don't think rupee at 69, rupee at even 70 or 71 should be a big worry when you see it in the longer term context. Obviously, when it falls sharply, the market volatility and all creates upheaval, but some amount of, I think, rupee weakness is also a good reminder that people should hedge their currency exposure. We should not allow huge amount of foreign currency borrowing. India has been very careful on all that, so it's always good to reiterate that. You are very right. I don't think the economy has suffered a lot because of GST, because I think GST has had a lot of benefits. There have been pockets of issues like refund issues and tax forms uploading issues, and the technology has taken some time to stabilize, which happens when you have such a large rollout on a countrywide basis. But on the whole, I think the markets and investors are more reacting to global cues. In fact, from April to now, Indian market has been actually much better performing than other emerging markets. So emerging markets are under pressure. US interest rates are going up. As a result of that, money is flowing out of emerging markets. Oil prices have gone up, inflation has inched up in India. So there have been some headwinds on that, and the markets are reacting to that. But on the other side, the economy is improving at a micro level, at a company's level, whether it's in steel, it's in cement, it's in automobiles, it's in housing. We are seeing real pickup in demand. So on the whole, I do believe that the actual micro improvement in the Indian economy, having absorbed the effect of demonetization, GST, the economy is coming out stronger, and that should allow us to combat the headwinds that have been building up.
So, Mr. Shah, what would you advise the average investor, the trader? What should he be doing? Should he be playing safe? Should he be doing very deliberative stock picks? I'm not asking you for specific recommendations, but how should one approach the market in the near term, Mr. Shah?
So it's always hard to say in the near term, because nobody knows in near term. I have no idea what is going to happen to the market in the next 3 months. But what I would say is, I think first investors should understand their own risk profile, their own requirements. If you have money which you need in 3 months or 6 months, then keeping it in a bank FD or in a bond, in a short-term bond instrument is the best possible thing to do, because you can't afford any drawdown or erosion of capital. But if you have capacity to invest for 3 years and 5 years and 7 years, I think what it appears the next 3 months to 1 year will be a great time to invest. There are some good high quality companies in India which will get reasonably priced as the markets come down, and investors can look at an opportunity to make good long-term investments at good entry prices also. But goes without saying that anybody investing in equity market should have at least a 3 to 5 year horizon, ideally a 5 to 10 year horizon, because that's the only context in which you can invest in equity markets. You can't invest in equity markets with a 3 month to 6 month view, because the volatility will always be there in equity markets. But I think the growth in India, the growth in Indian economy, the kind of pickup, the consumption demand, the investment demand that is there in India will ensure that our economy, our corporate earnings will continue to do well, and we are fairly well poised. There are external factors, as you said, but overall we are well poised. But you have to take at least a 3 to 5 year view.
One of the points I want to ask you, in your position as the head of one of the largest industrial chambers in India, the FICCI, is the latest third cancellation of ministerial delegation level talks between India and the United States. It was supposed to happen on the 6th of July. It has been called off by the United States, and there are fears that a trade war between US and India is back in play, despite us having, a very small share of the problems that the United States has. People would have expected the US and China to fight, and it suddenly seems to be becoming an issue between India and US. What is your take on that, Mr. Shah?
Absolutely. I think India is a very small player. India contributes to around 2% of the global trade overall, and even on the trade, on the balance of trade front, India doesn't run a surplus with the US in a big way. So I think, but as you know, it is not a US-India trade war, it is a US with the world trade war. They are fighting with the European Union, with Canada, with Mexico, with China, all of them. So India is also caught in that. I was hoping the ministerial level talks do happen, because we need to de-escalate, not escalate the trade war. And I think the best thing India should do in this is not get caught in any crossfire, but use our personal connection between India and US. We have a lot of cultural ties, but also at the same time, India is not a big threat to USA in terms of the balance of trade and all. So we should make sure that we continue to talk, we continue to de-escalate, and continue to convince US that while they are fighting with everybody else in the world, having good, strong trade and business relationship with India is in both of our mutual interest. And I think our view at FICCI has also been that with a lot of countries, we need to continue to talk. We need to invest a lot, government to government, but also business to business, and just make sure that we de-escalate this building trade war in the world, because this trade war is going to harm everybody. And as far as India is concerned, we have to continue to say de-escalate, communicate, talk, and just build linkages.
That's a very important point, because Suresh Prabhu just the other day speaking to us on BTVI had actually in fact said that India was willing to even further delay the reciprocal duties beyond August 4, but it seems despite that olive branch, the US has taken the stance it has. One of the points that you mentioned, and to get your comment on one more important aspect of the economy, the RBI's latest report.
Well, that is an exclusive conversation that we're having with Rashesh Shah, saying that the next 3 months to 1 year, a good time to invest in markets, are not spooked at all with the kind of turmoil that we've seen recently. With the market, for its part,